Get Rich Education is brought to you by Norada Real Estate, the real asset investor, and Mid-South home buyers.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
You are inside Get Rich Education, episode 119. Hi, I'm Keith Weinhold, with listeners in 177 nations, from Uruguay to the UK to the Ukraine to the UAE to the USA. Thanks for being here, but you're not here for me, you're here for you. What's going to happen with mortgage interest rates and the stock market and oil prices and inflation and real estate prices and more? Today, we're going to get predictions from one of the world's best-known financial prognosticators, Harry Dent. And, I'm just going to flatly ask him a question like, what's the price of a barrel of oil going to be at the end of this year? And where's the stock market headed next? And I wouldn't ask most guests those questions because, frankly, they'll give some vague answer and tell me that they don't know. And, well, frankly, I might have to answer the same way. But see, this is what Harry Dent does. He makes predictions. I think he wants me to ask those questions. When you make a lot of predictions, not every one of them is going to be right. In fact, do you know the only way to never make a wrong prediction? The only way to never make a wrong prediction is to never make a prediction. People listen to Harry's predictions because the depth of his research is so extensive, and he gets a lot of things right. Harry Dent came onto the show with me last year, and one of his more bold predictions at that time was that the Dow Jones Industrial Average is going to plummet to 6,000 points this year. Now, I'm in Costa Rica today, but back in Anchorage a little while ago, I was watching television. I think it was Fox, while I was running on the treadmill, and Harry Dent basically said that he admits that he got the Dow to 6,000 points thing wrong, or at least the timing of that prediction wrong. So I figured I would give Harry a call and let him tell you what's changed and why. I care about you deeply as a listener. Without you, I don't even have a show. And when one of the world's top financial prognosticators course corrects, I want you to hear it so that you can plan accordingly. The Donald Trump surprise presidency has something to do with this sea change, and it's actually interesting timing here to talk with Harry today because today is Inauguration Day for one Donald J. Trump. And how badly do I want you to have this information? Because I'm doing this show while on vacation, just like I will be next week too. I'm in San Jose, Costa Rica today. My business developer and best friend, John Collins, is somewhere around here, and we're both kind of early to bed, early to rise guys. We're more likely to go on a crocodile tour by boat or a jungle trek than go out to a nightclub. So mixing in some GRE fits here, and we're usually in bed by 9:30 p.m., and all the girls in the club are basically dancing to Bruno Mars anyway, just like they are back in the States, so there's hardly any cultural immersion there. Let's talk market predictions with the incomparable Harry Dent. I'd like to welcome in today's guest. You've already heard of him because he's a rather famous financial prognosticator. He earned his MBA from Harvard Business School, and he's been a best-selling author for decades. He's appeared on your television, on Good Morning America, CNN, Fox, and CNBC, and his work's been featured seemingly everywhere in the USA Today, Barron's, Investors Business Daily, Entrepreneur, Fortune Magazine, Success Magazine, U.S. News and World Report, Business Week, The Wall Street Journal, American Demographics, even Gentleman's Quarterly. His latest book is called The Sale of a Lifetime, and he's the editor of the free newsletter called Economy and Markets, and you can get that free newsletter at harrydent.com. Welcome back to Get Rich Education for your second appearance, Harry Dent.
Yeah, nice to be back.
Yeah, it's great being with you, Harry. We're kind of at opposite ends of the Caribbean today as you're joining me from Puerto Rico. I'm in San Jose, Costa Rica here, and you were last here with us last year telling us that, among other predictions, that the Dow Jones Industrial Average was poised to fall to 6,000 points this year. Well, with the surprise Trump presidency, do you want to tell me that you're wrong on that and you'd like to change that, or what do you think?
Yeah, the market really was in what we call a head and shoulders pattern where it had gone nowhere for 2 years and just couldn't seem to make a substantial new high. So we thought there was a good chance that would roll over. And then I tell you, on the Trump thing, the market went down 900 points overnight and then went up 1,100 above that. I mean, a 2,000 point rally in 24 hours. And that changed everything in the stock market charts we're looking at. A lot of divergences. You know, when you see the large companies doing well, the large caps and the small caps underperforming, that's a sign of a major top. Well, that got reversed. When you see the Dow Transport's doing poorly, but the Dow Jones Industrial is doing well, that's another sign. All of those things were reversed. The stock market has now entered what I call a fifth wave kind of blow-off rally. Fifth wave means a final wave up. And so this has gone high enough now that it should go a good bit higher. My forecast now is that the market's likely to trend up, not so much now. It's already made a big move in a short period of time, but trend up probably into this summer. And then we see the beginning of the next crash. And that next crash is going to typically takes 2.5 years for this to work out. So I see a potential crash starting, say, maybe around July or August, and then you get a really hard hit when a bubble bursts right off the bat. This happened in 1929 with the Dow, down 45% in the first 2.5 months. It happened in the tech wreck in early 2000, down similar. The Nikkei, the Japanese stock market, when it finally, the bubble peaked and started going down in 1990, well, it's 45% in the first 2.5 months. And then the Chinese market just did this late last year. So I keep warning investors, you know, the bubbles don't end well. They keep going up. They keep sucking people in. And now everybody's gone for this Trump thing that he's just going to wave a magic wand and cut taxes and make some infrastructure investments and cut some bureaucracy. And we're going to grow at 4% again, like in the 50s and 60s. I'm telling you, this is not going to happen. The Japanese have been stimulating 3 times the rate we have and for much longer. And they still can only grow 0 to 1% at best. 20 some years later, real estate fell in Japan over 60% and is still near its bottom. Stocks fell 80% at worst and are still 50% off their highs and due to go down again. So we're in a different world, and it is all about demographics, and it's also about very high debt levels. And we're the best house in a bad neighborhood. We've got less of a debt problem than Japan does, or the UK, or much of Europe. We've got sideways moving demographics, which is a lot better than Europe or Japan or even now China at this point. So, you know, we still look better than most countries, but the whole developed world is in a whole new era. And what I keep telling people is governments keep this bubble going by just printing more money, whatever it takes. And now Trump's going to do fiscal stimulus, tax cuts, you know, infrastructures and stuff. You can only keep a bubble going so low on something for nothing policies. And nobody really gets, I mean really almost nobody gets, the fact that for the first time in all of modern history, since the Industrial Revolution 250 years ago, that the whole developed world, the richest countries in the world, are all aging. Even emerging countries are aging, just not as fast. They're all aging, and it changes everything. Old people don't get more sexy. They don't get more productive. They don't spend more. They pay down debt, and they spend most of their money on real estate by their early 40s or so. And then when they move in a nursing home or die down the road, they become sellers. And so, I mean, we're not going to grow at 4%, no matter what Trump does. Businesses aren't going to reinvest because they cut taxes, because they've already given them free money. Long-term rates have been zero, adjusted for inflation, for many, many years, and all they've done is buy back their stocks to improve their earnings per share. They haven't expanded their capacity. Why? They already overexpanded in the boom. Consumers overborrowed and overspent in the great boom, and real estate, of all sectors, was the most overbought and borrowed against. that's why, real estate can come back with extremely cheap money. No sector benefits more from free money than real estate, but it's not going to come back as strong as it did before. And as soon as the economy weakens, real estate's going to be weak because there's mortgages against it and all this stuff. So, but my thing is aging. We've never seen an economy where most major countries have a generation that's not as large. It does not have as much peak spending and everything as the generation before. That's just never happened. And nobody gets. Everybody thinks there's some magic formula from the Fed or Donald Trump to get us back to the growth we had in the 50s and 60s and even the 80s and 90s. And it's just not going to happen. And Japan's already proven it. Everybody should study Japan, real estate, demographic trends, bubbles, as they had the first major bubbles in the world. Their generation peaked way before the U.S. and Europe. And then one country after the next just keeps peaking and slowing down. So this is a reality. And Trump can't change demographics. You can always give people a little more free money, lower mortgage rates, and they'll spend a little more. You can hire back all the people that were laid off in the 2008, 2009 recession. But we're getting to the point now, Keith, where we've hired almost all those people back. There's no way we can keep growing at 150,000 plus jobs a month with the natural workforce growth rate, for the same reasons that real estate's going to slow down, is that there's going to be increasing number of baby boomers retiring at age 63 on average and offsetting increasingly the millennials who enter the workforce at age 20, 21 on average. So the workforce isn't going to go anywhere. Net demand for real estate, when you take away the younger buyers who peak in their early 40s, but subtract out the dyers, I call them, older people who become sellers when they die. And that's not only do people not spend much money, invest much money in real estate after their early 40s, when they start to die, they are sellers. There's just no two ways around it. Either you give that home to your children and now they don't have to buy a home, or it goes on the market into your estate because dead people don't own real estate.
Right. Well, I want to get into that a little bit more in a moment with what we think are going to happen with interest rates, especially as that affects real estate investors, since we're typically big borrowers. And I'd agree that the United States does not have maybe a fundamentally healthy economy and currency, and maybe we just have about the least worst economy and currency in the world. And with the Trump presidency kind of being this X factor, it's interesting that we are talking about this, by the way, on Donald Trump's inauguration day. The subtitle of your latest book, called The Sale of a Lifetime, is How the Great Bubble Burst of 2017 to 2019 Can Make You Rich. And I'm assuming that's still valid with the Trump presidency. You've talked about how we're going to teeter and go into a bubble. But what are some of the catalysts fundamentally for that bubble, that stock market bubble specifically?
Well, again, first thing, the markets have rallied and everybody's gotten more confident, thinking, well, Donald's just going to change some things and get some obstacles out of the way, and we're going to grow at 3 to 4% again. We've been struggling to grow at 2% with unprecedented stimulus and money that costs zero short-term and zero long-term when you adjust for inflation. The most stimulative time in all of modern history, and we can only grow at 2%, Europe 1%, and Japan closer to zero, because of aging and all these things. So I think, number one, it's going to take, that's why I give it out to about the summer. It's going to take maybe 6 months for people to get, number one, Donald's not going to be able to just dictate everything he wants. He's going to get resistance on something, even from a very now divided Republican Party. And the Democrats are now, getting their claws in like the Tea Party did and just going to block everything he does. But most of all, number two, the economy's it's going to run out of this job-creating power. We basically, I think, are just months away from getting to that point where, there's no more people to rehire that were put out of business, and baby boomers are just going to keep retiring, and younger people are not going to enter fast enough to create workforce growth. So we're going to have basically zero workforce growth, zero productivity. And that's where we're at now, Keith. We're back to almost zero productivity rate. And long-term GDP growth is just population growth or workforce growth plus productivity rates. And we're basically close to zero on both. And I don't see a way to get it to 4%. I don't see how we can even sustain 2% past the next year. So I think we do get this blow off top. It just makes stocks more overvalued. Same for real estate. And then when we run out of steam and people are disappointed with the economic progress and more aging and trends hit, and let's say interest rates go even higher, and we've been predicting for the last year that the 10-year Treasury bond would go up as high as 3% to 3.1%, and that would start to hurt, obviously, mortgage rates and real estate, and it certainly would start to work against higher stock valuations. So I think those are things going to happen. I think globally, it's obviously that Southern Europe, Greece is still in deep trouble. Italy is getting in deeper trouble. Deutsche Bank, the largest bank in Germany, I showed like, a year and a half ago, was in trouble. Bank stocks are doing poorly except for this recent rally. But the biggest thing of all to me, Keith, is the Chinese bubble of overbuilding, especially in real estate and infrastructure. They have so many empty condos and malls and office buildings and railways to nowhere and bridges to nowhere. They're building stuff for nobody to accelerate urbanization. And in 2015, nobody noticed for the first time, all these rural migrants who aren't even legal in these urban areas, registered citizens, they started going back home. Real estate too expensive, traffic horrible, pollution horrible, and they get treated like second-class citizens as if they were illegal immigrants in the U.S. from Mexico or something. So now they're building stuff for really nobody. And the Chinese real estate bubble has to collapse. It's the most overvalued in the world. And when it does, the Chinese are the lead global buyers for buying in English-speaking cities from Manhattan to San Francisco to Vancouver to Toronto, London, Singapore, Sydney, Australia, Melbourne. These cities all go down when the Chinese stop buying, especially on the high end. So I think that's the ultimate. We got problems in Europe. We're not going to start this crisis like we did in 2008 with our subprime. And we are the best house in a bad neighborhood. Our demographics are not good, nothing like in the past, but they're definitely better than Southern and Central Europe. They're way better than Japan and the rest of East Asia. And now China weakens for as far as the eye can see, and nobody's taken that into account. So at some point, I think in this year, right around the middle, right around the summer, I think reality sets in. Oh, Trump didn't get this. He got this, but didn't get this. He cut taxes or whatever they did, and businesses still aren't raising capital investment. And the economy's still not growing at 3 to 4%. In fact, I don't think we're going to sustain the growth we've had for many more months, as I said earlier. So I think the reality just sets in, and now stocks are higher value. Now real estate's a little higher value. And now you just have further fall when reality sets in. But it's got to set in sooner or later. We cannot grow at these rates. And no bubble can keep going up. Bubbles defeat themselves. High prices cure high prices, period. And there's no bubble that's gone up the degree real estate has in key cities around the world and stock markets around the world and commodities, which have already largely collapsed. They can't go up for too long without having a bubble burst. And then the bubble bursts tend to be twice as hard and twice as fast as the bubble builds. And that's what I keep warning people. Hey, I'd rather be out 6 months or a year early than 6 months or a year late, because you get knocked by that first whack. And that's what happens in stocks. Real estate doesn't tend to go down quite as fast, but real estate gets much more illiquid quickly, and it can just be hard to find a buyer, period.
Yeah, people try to time it and sell at the top, but no one can exactly hit the top. So, yeah, you're a lot better off 6 months early rather than 6 months late. Well, today, we do have a real estate guy moving into the White House. And I know that you mentioned that Donald Trump cannot control demographics, and demography is our destiny. You're Mr. Demography. So, I think with the real estate guy moving into the White House, we feel like as real estate investors that we're going to be protected from some things, that the 1031 tax deferred exchange is going to stay in place, that the mortgage interest deduction is going to stay in place. I just learned last month from talking to Rich Side advisor Tom Wheelwright that Trump's group was basically the one responsible for getting the real estate professional designation put in for real estate investors. So these are all positive trends for real estate investors. But one potentially negative thing of a Donald Trump presidency for real estate investors, and this might fly in the face of what you think, is if Donald Trump can control immigration, which is something that he's stated that he would like to do, that's typically something that's not good for real estate investors. But if Trump controls immigration, can he actually help control demographics?
Well, again, limiting immigration only works against demographics. The difference between us and Japan and certain parts of Europe that have such weak demographics, we're not having more babies with the native citizens than they are particularly. We just have had higher immigration. Countries like Australia and Canada even higher, and they've got better demographics than we do, as does Sweden and Israel and some other developed countries. So immigration is a plus. Now, there's high quality immigration like Canada and Australia get, and Switzerland and Sweden, but even lower educated immigrants from Mexico, even illegals, most of these people work hard and they contribute to the economy and they spend money here. And I always say, look, if you're going to compete with these workers, if you got everyday skills, whether you like it or not, they can produce cars or anything from Mexico or China. Wouldn't you rather have more of these people here, where they rent or buy a house here, where they pay taxes here, where they buy food here and stuff like that? They're competing with you either way, but when they're here, they're contributing to our economy. When they're competing with us from Mexico or China, we get nothing from them except for lower wages from wage competition. So I am pro-immigration. In an aging world, all developed countries should be competing for immigrants, and particularly the best immigrants. And again, the model countries are like Australia and Canada. They target higher educated skills they need. They attract good English speaking or people who want to learn English. And their immigration, you go to Australia, and the Asian immigrants there are above average in everything. Income, intelligence, all that sort of stuff. So they're not pulling the economy down. And I'll tell you, Trump, if he were to ever ship 11 million people back to Mexico, we would have a deep recession on that alone from the absence of their work and contributions and their spending. And you'd have a lot of businesses that wouldn't have employees for certain jobs that they do the best at the lowest price. So, his control of immigration to me is only going to be a negative because he's going to limit it.
I am descended from immigrants just like you and just like most of our listeners. When Harry and I come back, we're going to talk about why interest rates are headed up and how that's going to affect you as a real estate investor. I'm Keith Weinhold. Our guest is Harry Dent. This is Get Rich Education.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.
As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education. We're talking with Harry Dent. Harry, you think that interest rates are headed up and then later they're going to go down lower than ever. Talk about that and how that's going to affect real estate investors in your opinion.
Yeah, there's two things we've seen driving rates up, and we've been forecasting this since late last year, that in the early stages of this next crisis, these rates that have been pushed down by central banks buying their own bonds, and then hedge funds and leveraged traders, they levered up at low short-term interest rate costs and then buy these long-term bonds, sovereign mortgage bonds and stuff, and push them down even more because they think like it's a free lunch. Governments are going to keep buying them, pushing rates down, and they can't lose. But at some point, two things happen. Everybody gets in on the trade, and then it starts to reverse from lack of new investors to come in, and that's happening. And then when the bond rates go up because of that and the bond values go down, these leverage traders and hedge funds get margin calls, and then they have to sell it, and it makes it worse. But the second thing is also very simple. Inflation is a lagging indicator, actually, as jobs are. Businesses are slow to hire coming out of a downturn, and they're slow to fire coming into the next downturn until they really convince, because it's a major investment for them. But inflation is the same, and we're seeing just some late stage inflation after, unexpectedly low inflation for so many years, and that's pushing up yields. So this continues for a while, actually a whole lot longer. We've been saying when the 10-year Treasury gets to 3%, we're at the top of a long down range, down channel of interest rates that would say, hey, this is when you want to buy long-term government bonds like a 30-year Treasury, and this is when mortgage rates are likely to peak. So I think that's coming sooner or later this year. The reason rates go back down and the reason the bond bubble is the only one that stays when all the other bubbles burst, which includes commodities, which have already largely burst, real estate that has burst once, stocks that have burst twice and are on their third bubble, that's the safe haven. And when these bubbles burst, debt deleverages, especially against real estate, financial asset bubbles burst, this destroys money and creates deflationary forces. And the one investment, and this is the one investment that did the best in the 1930s, the worst downturn and deflationary crisis in modern history, was long-term, high-quality bonds. So the decline of the economy, the debt deleveraging, the bubbles bursting, favors high-quality bonds. Not junk bonds, not subprime loans and stuff like that. It favors the highest quality long-term bonds, and that pushes rates back down. So I think, mortgage rates have come up over a point. They could go a bit higher, another half a point or so. But I think ultimately you'll see the 30-year Treasury bond more like, 1.5%, the 10-year 0.5% to 1 max, maybe closer to 0. And that'll bring mortgage rates down, especially in higher quality mortgage loans. And that long-term will be good for real estate. But the problem is, part of the reason those rates go down is real estate and mortgages deleveraging and creating deflation. So the first part means with first, real estate will go down. But I've been telling younger buyers, millennials, hey, if you'll just hold off buying that starter home, down the road, not only are real estate prices going to go down farther than they did last time around, but you're likely to get an even lower cost long-term mortgage rate. So prices cure prices, and a downturn brings down prices and makes things like real estate and stocks more attractive, brings interest rates down, that's more attractive, but it's painful. So we're telling people, you just got to get out of the way. This is not a good time to buy real estate, and if you do, you got to buy positive cash flow and stuff to say, will rent even in difficult times, and there will be more renters than buyers in difficult times. So people who have good rental real estate, especially in areas that didn't bubble as much as, say, Manhattan or San Francisco or Vancouver or something, can still do well. But in general, most real estate is going to go down, and you need to wait to buy until it's at more affordable prices. And then, at least you can have decent returns in a market that I think will be like Japan, where the next real estate boom will not be across the board, and it will not be as fast to come back because of this older people dying and becoming sellers to offset the natural buying of younger people, which drives the market. And we've never had this before. So you do have to be in the right sectors. And the best sectors, is you mentioned before, is emerging countries like India. It's had endless demographic growth after we get over this crisis and falling commodity prices. Aging sectors, nursing homes. I would be buying in the coming years. I'd be buying or investing in nursing homes. They'll never have enough of them, as the baby boomers are just entering that rising demographic in 2017, this year, ahead, in hospitals and healthcare facilities, vacation homes. Baby boomers still have one more round of vacation and retirement home buying. But generally, you don't want to be in McMansions and larger homes, because the aging baby boomers are going to either want to move to a smaller home in an ex-urban area or downtown, not in suburbs. And then nobody's going to want the big homes, at least for the next decade, and apartments. Positive cash flow, the other good place to be, especially as more millennials are renting and will have to. And commercial is the worst. Commercial has the same thing like we call buyers and dyers. Commercial real estate generated by young people entering at age 20 on average, but also is hurt by retirees. When people retire, they don't need an office anymore. And they also don't spend much money in malls and stuff anymore. So commercial gets particularly hit hard by this factor of aging baby boomers offsetting younger millennials in the United States and even more so in countries like Japan and Europe.
Yeah, some of these trends are just so predictable. Maybe stock market gyrations and interest rates probably not as predictable as some of these that are getting close to ironclad, like the aging of our society and how that's going to be good for assisted living homes. Yeah, we focus on buying cash flowing properties sort of in the heartland of America, these sort of lower priced single family homes, oftentimes that you can buy for about $100,000 that do provide positive cash flow. So just along with interest rates for real estate investors, when we go purchase that property, we're tying ourselves to long-term fixed interest rate debt. What do you think interest rates are going to be at for a 30-year fixed loan 1 year from now? And then when is the point that they peak and fall?
I think they peak this year, and it could just be a matter of months. Again, I use the 10-year Treasury as the benchmark because we got some good long-term patterns on that suggest we're going to go as high as 3%. That means, mortgage rates are going to be, 4.5 or something. That'd be more like a peak. And then that 10-year Treasury could fall, almost definitely fall, I think, below the 1.38%, which has been the low thus far. And I see mortgage rates bottoming probably around early 2020, maybe a little after that. And then they'll start to rise again slowly in a modest inflation environment. But deflation is more the trend, especially for the next 3 years. I've got 4 indicators, Keith. The demographics is just the biggest one, but 3 other ones. They all point down together into early 2020 before some start rising and then more later. So the next 3 years, my indicators say are going to be the most challenging. And I just keep telling people, yes, governments are stimulating like crazy, throwing the kitchen sink at everything. But you can't fight trends this bad for that long. And it's just going to make the crisis worse when it happens, when you stretch companies more and you stretch debt more and you stretch households more, trying to keep the bubble going. When it bursts, it's just going to be worse. And so I think people just need to be safe. And you are in the only sector in real estate, like I say, affordable rental properties with low cost financing that didn't bubble that much is the only place I can see people making money in real estate in the next several years when the economy's at its worst. But once we hit bottom in a lot of things, and there's a lot of areas I mentioned earlier you can make money on, but in the downturn, only solid cash flow positive real estate aiming at renters is going to have a shot, and only for renters and households, not for commercial. The businesses desert their leases and stuff way faster than consumers. Consumers have to live somewhere. Businesses can just fire employees and, shut down their capacity.
Yeah. Now, you're hearing Harry reference the gyrations in the Treasury note, and you might wonder why. Well, for one that gets a mortgage, your mortgage interest rate is more tied to the Treasury note. It's not tied to those changes in the federal funds rate that Janet Yellen announces, although there is a more loose correlation there. But your long-term mortgage is more tied to the Treasury note, and that's why Harry talks about that sometimes. Harry, I want to know a little bit more about inflation, deflation, and especially as that ties into oil prices and what you see oil prices doing. Oil prices are such an influencer on whether we're going to have inflation or deflation because the price of a barrel of oil, that affects basically every good that needs transportation. And as real estate investors, inflation benefits us more than deflation because when we do take on this long-term fixed interest rate debt, inflation erodes that away for us. So what do you see with oil prices and inflation versus deflation?
Oil prices have a problem. It's called the U.S. fracking industry. When things get really bad, the frackers are highly leveraged and they're marginal producers. They're not low-cost producers. They're high-cost producers. And they start defaulting on their debt and going under. But when oil prices prices rise, like when OPEC gets together and makes an agreement to cut production, as they did recently, the more the prices go up, these frackers can move back very quickly because they're shallower wells, don't take as long to drill, not as capital intensive. They can move back production really quickly, so it limits oil price bounces. I think oil is much closer to peaking on this rally it's had. And a lot of people say it's going to go to 70, 80. I don't think it makes it over 62 if it makes it to that. And the next downturn in the economy, which I think will hit in the second half of this year, oil's just going to crash again. And if it went to 32 the first time and 26 the next time, I think the next stop is like 20-ish. And at that point, boy, the frackers start falling like flies, and that just reinforces that for a while. So oil is another thing that plays into the deflation argument. All commodities, gold keeps going down because gold is an inflation hedge. It's not a deflation hedge. And another thing you were saying earlier, how the rising inflation helps offset your financing costs. Your mortgage costs and stuff. It also, real estate benefits from inflation. Real estate correlates long-term with inflation. That's the one thing it correlates with, as does gold. The difference between gold and real estate is that you can rent the real estate out or save rent. Gold, you don't get that. So gold's the worst investment. And it only does well in inflationary times like the 70s, and it's not a deflation hedge. Deflation will hurt real estate, but when we get back in a long-term modest inflation trend, it's going to be positive for it. And I think really, as Robert Shiller shown back to late 1800s, that real estate long-term is going to grow with inflation. And when you've got that on a mortgage and leverage, then you've got a good play. But I still see deflation being more dominant the next 3 to 6 years. And that's what makes me most cautious on most real estate, in addition to the demographic trends that it's not good in most areas except in the rental market.
Yeah, and also with the inflation-deflation tug of war, we have globalization, which flattens wages, and in advanced economies, that's a deflationary force.
Yeah.
But then in the United States, it's sort of interesting. We have this power of basically to print all the currency that we want to stoke inflation at the same time. Any thoughts there?
Well, again, people have to remember that what all of this money printing and quantitative easing, what governments are really doing, they're fighting deflation. They would like to see 0 to 2% inflation. What they don't want to see is deflation. There's no way somebody's going to create 5 to 10% inflation in this environment in the United States, Europe, or Japan, because the aging of our societies is deflationary, and debt deleveraging ultimately and bubbles bursting, which they are one after another. Again, we got to admit the commodity bubble's already burst. Oil's already been down 80%. Copper's already been down 70%. Iron ore's been down 80%. Steel. The commodity bubble is 80, 90% burst. Well, the same thing's going to happen in stocks and real estate, and that does destroy money. And when you have less money chasing the same goods, then you do get deflation in prices. And so the investors that are in positive cash flow sectors or who just convert their assets, financial assets, to cash or near cash, those people now can benefit. Deflation works in their favor. Everything gets cheaper, especially leveraged assets, financial assets like stocks and real estate and commodities and even gold. One day I'm going to be a buyer of gold when it hits $400 because it'll probably go to 4,000 to 5,000 in the next long-term commodity cycle, which peaks every 30 years. And as we're talking about inflation, we see major inflation peaks, 1920, 1980, and the next one is around 2040. And then you see falling inflation, and then somewhere farther down in the cycle, like where we're coming into now, you see deflation in prices. This is a predictable 60-year cycle. So it's exactly how it happens is not clear or when, but the fact that inflation would peak in 1980 and be falling ever since is a totally predictable trend.
Well, Harry, I care about my listeners deeply, and I want to ask you a question, and you have a chance to talk to over 10,000 listeners here, over 10,000 families. Your latest book, The Sale of a Lifetime, with it being subtitled, How the Great Bubble Burst of 2017 to 2019 Can Make You Rich, is there any actionable thing or anything that you didn't get to bring up that you want to tell my listeners for how they can best position themselves and their families as investors in the economy to come?
Well, the big thing is, I hate to say it, this is not a time to listen to your typical stockbroker who's going to say, oh, stocks always come back and we've got asset allocation, have you diversified? No. In 2008 and 9, especially in late 2008, when things got tough, everything went down, including gold and silver, commodities, real estate, small cap stocks, large cap stocks, Asian stocks, emerging market stocks. Everything went down except for high quality like rental real estate and high quality bonds, and the U.S. dollar actually went up 27% while gold was going down 33%, and stocks were crashing 50 to 60, and real estate crashing 30 to 35% on average and stuff. So you got to be safe. You got to get from risk on, out of bubbles, into safe stuff. Cash flow, positive real estate, and cash-like investments, high-quality bonds. And then, like I said before, when all these bubbles burst and all this debt deleverages, all it does, things go down. I mean, to 10, 20, 30 cents on the dollar in stocks and commodities, and 40, 50% on the dollar in a lot of real estate. And now that's why we call this book the sale of a lifetime. If you just get safe over the coming months and you just hunker down in your business and your investments, this crisis will make you rich the fastest you ever got, because everything's going to be on sale, and only the people with good credit, cash flow, and cash can take advantage of it, because nobody's going to give you money. So if General Motors is down 90%, are you going to be able to buy it if you just lost 90% on your stock portfolio? You're not going to have any money to buy it because your financial assets went down. And if you're sitting in typical commercial real estate or in a McMansion that used to be worth $2 million and it drops to $800,000, you're underwater. You can't even refinance at the lower mortgage rates, nevertheless buy any more real estate. So that's the thing. And I think that this switch is going to come about mid this year, where all of a sudden there's going to be a chance for investors to get in the highest quality bonds and cash-like investments and get out of risk assets like, junk bonds, stocks, commodities, and riskier real estate. And that's just one simple insight is a way to position yourself to make a lot of money over the next few years, while most people, unfortunately, and I wish I could change this, but I can't, most people are going to lose a lot of their net worth. And you know what? The richest people are going to lose the most this time around, not Homer Simpson, because they're the ones that are in the most of these risky assets and own all these leveraged hedge funds and stuff. They're going to get killed by this deflation.
Well, that's great to hear. I think it really affirms what I'm doing, where we focus on carefully purchasing smart, residential, cash-flowing real estate in stable markets, typically away from those volatile markets on the coast. Well, Harry, it's been insightful as it was last time. I really give you a lot of credit for basically saying that you were wrong and things have changed significantly in light of a Donald Trump presidency. How can our listeners find out more about you?
The best way, harrydent.com. We have a free daily newsletter, as you said before. I think right now also this new book that we're giving this away for shipping costs, $4.95. So people, both of these things are just designed. Look, if something I've said sound interesting here and especially realistic, I think I'm the only realistic guy left out in la bubble land out there, but you can get to know us. And, we've got more services and stuff. And between the book and our daily newsletter, you're going to get a lot of useful information. And even if you didn't have a dime to your name, it'd be good cocktail party talk, I tell you.
Well, you can check out all those resources again at harrydent.com. Harry Dent, thank you so much for coming back on to Get Rich Education.
Okay, enjoyed it again, Keith.
Yeah, great stuff from Harry as always. It's important to know that Treasury yields only affect fixed rate mortgages, the 10-year note affecting 15-year conventional loans more, while the 30-year bond affects 30-year loans. But, the correlation there isn't absolutely perfect in direct lockstep either. The Fed funds rate, the one that Grandma Yellen changes, that affects adjustable rate mortgages like HELOCs, and it also affects the prime rate and hence credit cards. Harry Dent studies demography. A lot of the world's top economic thought leaders study demography. Economists study money. Geographers study sort of land use. Geologists study the physical earth. And demographers will tell you that their discipline matters more because demography is the study of people whom interact with money, land use, and the physical earth. Your demography is your destiny, and it definitely helps one make predictions. The next two shows, we're going to have a very actionable resource for you as we dig deep into one particular geographic real estate market. It's actually one of the very few coastal markets that has a cash-flowing sweet spot. We've also got a show with Profit Boss Radio's Hillary Hendershot, where we'll discuss money mindset. Hey, thanks to Harry Dent for returning on to GRE today. Do you want to grow your wealth? Get his free forecasting newsletter at harrydent.com. Get my free wealth building newsletter at getricheducation.com. Signing off from idyllic San Jose, Costa Rica today, I'm Keith Weinhold. I'll be back next week to help you build your wealth. Now go out there and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.